insurance premiums now make up more than 75% of our overall business. Right now, I'm treating them just like my company's collateral. I rely completely on these premiums to protect me from any type of risk. This trigger point is downright frightening. It's an extremely dangerous way of thinking and acting.
Hello everyone, this is the comprehensive industry talk show, WallTech Family, brought to you by WallTech. Today we are honored to welcome the outstanding CEO of Xiaoniu Cargo Insurance, Ms. Chen Jinhua. Ms. Chen, welcome. This is the first time we've had a female guest join our show, and she's truly remarkable. Thank you very much. First, we'd like to hear your perspective. Since April, how has the trade war impacted insurance premiums overall from an insurance standpoint? Could you share with us what changes you've observed in this area?
To be honest, I was actually quite surprised. I truly didn't expect it. I originally thought that in the context of this trade war, our entire business would be significantly affected. But in reality, looking back at March and April, we saw that compared with March and April of last year, our total insurance premiums actually increased by over 75%. That's a very strong result. Month over month, April saw a roughly 30% increase over March as well.
That is certainly an excellent performance. So, what is the reason behind this? As expected, many carriers suspended U.S. routes by late April after the disruption. Overall, shipments to the U.S. in April dropped by around 70% across the market. Why did retention drop just 40%?
Through analyzing a large volume of insurance data, we identified several key details. What we've observed is that there are several dimensions at play. First, there's now a much wider variety in the types of goods being shipped. In the past, exports to Europe and the U.S. tended to be dominated by bulk categories, mainly everyday consumer goods. These products might be higher in quality, but their shipment values are relatively low. In recent months, we've identified 4 major categories of goods whose shipment volumes are significantly higher compared to previous years or the same periods in the past. First, dangerous goods, primarily lithium batteries. Second, new energy vehicles. Third, photovoltaic products, including solar panel components and similar items. There's also heavy machinery and equipment, as well as high-tech products, which have become particularly in demand over the last couple of years. Previously, I used to overlook these kinds of products, but now I pay special attention to them, especially drones and robots.
Regular goods once dominated insurance requests, but now special cargo requiring higher premiums is in greater demand.
Their premium rates are different from regular goods. The insurance rates are distinct.
Special cargo rates start at 0.13 to 0.14%, much higher than 0.02 to 0.03% for regular goods.
For certain precision instruments, the rates can even go as high as 0.7% or 0.8%. These are usually very high value items.
So when we calculate insurance premiums, should the declared cargo value typically include tariffs or not?
Vincent, that's an extremely professional question. Even if you're not a pro in insurance, you're definitely an expert when it comes to spending money.
The rise in tariffs has indeed led to a substantial increase in the insurance premiums for this segment.
Previously, most insured 110% of cargo value. Now, many opt for 120% for added safety.
Exactly, that helps cover part of the risk, right? When tariffs go up and costs increase, we actually include that extra insurance as a kind of risk buffer.
It helps, but insuring up to 130% only buffers about 3% of risk. Unlikely it's just to offset tariffs. So for a lot of cargo owners or trading companies, this really is just a drop in the bucket.
So this brings us to the second scenario. What we're seeing now across the industry is a broad shift in shipping methods and routes. In the past, I might have shipped goods directly by sea, straight to Europe or to a particular destination port.
But now I might opt for more segmented or multi-stage transportation methods.
Sea rail and China-Europe rail are rising, with some taking longer routes for strategic reasons.
For high-value goods, shipping costs actually account for a very minor part of the total, truly minimal indeed. They'd rather spend more on shipping than confront tariffs head-on. Companies seek regulatory lowlands, routes or countries with minimal taxes and barriers. Using low-tax countries turns savings into profit. 3 key shifts: cargo structure, transport methods, and special cargo base rates. As a result, in the short term, you may notice that insurance premiums for the same period are increasing. Very few people notice this. I thought it might be helpful to share a quick insight. Cargo insurance is actually designed for the cargo owner, and as a freight forwarder, my company is simply a party to the contract. I can purchase insurance on behalf of my clients, but at the end of the day, this is a buyer-seller relationship.
The freight forwarder's main role isn't to persuade the client. If you've entrusted your goods to me for shipping, it's still your decision whether or not to purchase coverage.
Otherwise, if there's no insurance policy in place as a safety net and there's a loss, as the cargo owner, you'll naturally come to my company first.
The key isn't oversight, but using brokers to add clauses like waiving recourse to shift liability. But the right to pursue recourse against the actual responsible party is not waived, and this distinction is crucial.
In other words, you're essentially using the cargo owner's money to purchase protection for yourself.
Yet, many freight forwarders may think that once they buy cargo insurance, they're completely protected. But in reality, fee, they often overlook the fact that these policies are actually designed for the benefit of the cargo owner.
That's the core DNA. It protects the owner, not the forwarder. Using it as a catch-all shield is a risky misconception. That mindset is a very risky one.
Ultimately, the primary insured party is still the cargo owner. When it comes to freight forwarding or logistics companies, are there any insurance products specifically tailored for them? That's an excellent question. You've really gotten to the heart of the issue.
Fantastic, fantastic. Yes, there's a product called FSL, though different insurance companies have their own names for it. In Chinese, it's known as Freight Forwarder Liability Insurance, and it's designed specifically for freight forwarders. This insurance is tailored exclusively for freight forwarders to manage their business risks. As an operator, I'd say it covers about 80% of the risks you face in your daily operations.
We've also had the chance to connect with the entire industry network. Our freight forwarder client base is quite large, with over 2,000 companies. We've also met with leaders from many different types of freight forwarding companies, large, medium, and small. When talking with them, we noticed that most of their liability exposures and insurance claims typically come from disputes with shipping companies, for example, container rollovers, rate hikes, vessel delays, unauthorized release, or cargo loss.
Let me just briefly explain as well. Freight forwarder liability insurance has 4 parts. The second is third-party liability.
If your container causes damage or contamination, it falls under third-party liability, also covered.
The amounts involved can be quite substantial, but the good news is insurance will cover these kinds of significant financial losses.
The fourth covers related costs, fines, compensation, general average, and post-incident inspections or investigations. Unlike cargo insurance, liability coverage is flexible. You might insure 1 million yen for a 10 million shipment, or 2 million, depending on what your business requires. Cargo insurance is needed as a supplement or deductible because you're also insuring on behalf of your customer. So if there's a loss, you would naturally claim on the cargo insurance first. But cargo insurance always has a deductible, and that's where your supplemental liability insurance kicks in to cover the gap left by the deductible.
If I'm the boss of a shipping company, of course I'd buy. That's what any boss would say.
But in reality, as we've discussed, there really aren't that many companies actually making these purchases.
For a lot of us freight agents, honestly, the main thing is earning more and pushing for higher profits, not wasting our time thinking about how to spend more or manage risk. First, sometimes they just never notice it. And even if I notice, I just feel lucky. Nothing bad ever happens to me, no major screw-ups.
Looking at things from a business owner's perspective, I always evaluate the ROI, the return on my investment, meaning what I put in versus what I get back. Typically, I focus on the total outlay, how much I have to spend, what the price point is, and above all, where the cost effectiveness lies.